Anand Shetty, who's Vice President Senior Fund Manager, Taurus Asset Management, joins us with a quick perspective on the market. Anand, good to have you on the show. What is your own sense of the market from a near-term perspective? Do you expect it to continue to remain range-bound?
The market momentum is lost, in a month of January when it didn't, meet the market expectation, whether in terms of UP Assembly or credit policy or in the budget. So clearly the momentum is lost and market moved into a range-bound zone. We consider the credit policy, the cut in CRR, cut in repo, is a significant sentiment booster, although there is no further trigger to the market. So we expect market to remain range-bound.
What's the call on banks then, post the rate cut?
Re-rating would happen, but policy rate cut not only is enough for that. I think investment cycle need to see a definite upturn to sustain the rally in the banking stocks. Although BFSI segment is currently attractively valued, we think a lot of opportunities available if one look at next 12 to 18 months period of time.
Do you prefer private banks to public banks post the rate cuts?
I think we would be selective across both the segments depending on the valuations, whether it's a public, private. We also look at a lot of companies from NBFC spaces offering attractive valuations. Economic upcycles generally are led by BFSI segments, and we do expect that policy interventions and investment cycles are taking upturn over the next few quarters. That should drive the stock from these sectors.
Sadanand, what's the view on the auto segment? Because that's the other rate-sensitive pocket which is shot up in trade. Are you bullish? Two-wheelers, four-wheelers, whichever interests you?
You see, if you look at companies that have done well, is basically one of the leading passenger companies and leading CV companies. But CV company which has done well is basically driven by international operations, where we have seen a sustained upgrades in the stock companies' earnings. We also have seen a major movement in passenger car companies, but we don't think a rate cut itself is enough. This could only impact the top line. One has to look at the operating cost and profit as well. General assumption is that two-wheeler will have a muted growth this year. Definitely this offers an opportunity, but we would be pretty selective in that space.
What about infrastructure companies or debt-laden companies which are drawing interest post the rate cuts?
This cut in policy repo rate is basically positive for the entire economy and more so for infrastructure and construction company. What it does is it boosts the confidence across entrepreneurs and lead the investment cycle. That's something we would consider positive, but sustained rally in infrastructure and construction should be led by earnings upgrade. So there are execution challenges that need to be met, order book need to be filled. So all these things we think would, would improve in coming times, and we would expect this sector to do significantly well.
Finally, Sadanand, what are broad underweight and overweight calls right now in the market, and also what's the outlook on the IT sector post Infy and HCL Tech's numbers?
We think going forward, banking and financial sector, construction, capital goods, engineering company, realty company, we also think mid-cap segment should be doing significantly well and outperforming the market. IT sector, it's now pretty clear after more than three companies result that the issue of the company is more company specific than the system driven, and we have seen actually upgrades of two companies, whereas downgrades of one company. So clearly we remain positive, more so with the mid-cap IT companies, which would show much more predictability of earnings and in some cases expansion of margins. So our bias should be much more on the mid-cap IT companies, and we remain positive on the IT sector.